Hey everybody, if you like dividend growth stocks as much as I do, you're going to want to hear about a couple of sweet names that we just bought for our income builder portfolio. One company has grown its dividend 700% over the last 13 years, and the other has increased its dividend by more than 600% over the last 5 years alone. They are high quality companies that rake in the money, and analysts say both are trading at prices that are worth considering today. Hi, I'm Mike Nadell, here for the Dividends and Income channel. Before I go into detail about these companies, I'm going to ask you to hit the thumbs up at the bottom of the video, subscribe to our channel, and ring that notification bell so you get notifications of new videos as we publish them. I'll get to the companies in a second, but first let me say a few things about the Income Builder portfolio. We launched the IBP at the start of 2018. It's a real money portfolio that is funded by Greg Patrick, our co-founder here at this channel. Twice every month, I pick some stocks, and Greg puts in $2,000 a month for me to make the buys. Our main goal is to build a reliable, growing income stream, and the secondary goal is to experience solid total return. I believe doing both is possible. The IBP is 41 stocks strong, it's worth about $116,000, and it's generating almost $3,000 in annual dividend income. I'm always updating the portfolio's homepage on our website, so if you'd like to learn even more than what I'm talking about today, check out the link in the description. When we started the IBP, we set an income target, and that target is to produce at least $5,000 in annual dividends within 7 years' time. We're almost exactly halfway through that time period, and we're about 60% of the way toward our goal. So it's going great so far. We're not doing this to convince you to replicate the portfolio. No, we want to use the IBP as a way to discuss the process of portfolio building and to introduce interesting companies for further research. Companies like these two latest buys for the IBP. One is Broadcom, symbol AVGO. It's one of the world leaders in semiconductors, an industry that's been in the news lately because there's a shortage of semi-chips for cars, computers, cell phones, and so many other things that make our world go. The other is Comcast, symbol CMCSA. Comcast is a media, technology, and entertainment conglomerate that has leadership positions in broadband, cable TV, streaming services, programming, theme parks, and other well-known ventures. Broadcom and Comcast actually are positions we already had in the IBP, so we just added about $500 worth of stock to each of those positions with these buys. This was our third Comcast buy, but our first in about a year and a half, and it was the fourth time we bought Broadcom. We've invested almost $3,000 in Broadcom so far, meaning we've committed more money to that company than all others in the portfolio except Johnson & Johnson and Lockheed Martin. With a market-crushing total return of about 90% on our first three buys, the money's been very well spent so far. Hey Greg, you're welcome. Now let's talk for a minute about the delicious dividends that Broadcom and Comcast pay out. Comcast has raised its dividend for 13 years in a row, growing it from less than 13 cents a share in 2008 to $1 a share this year. That's the 700% growth I was talking about in the opening. Comcast has a yield of about 1.8%. As for Broadcom, their dividend growth streak is now a decade long, and look at how aggressive they've been these last 5 years. That compound annual growth rate of 49% has pushed the divvy from $1.94 in 2016 to $14.40 this year. That's 642% growth. Broadcom yields about 3%, making it one of the highest yielders in the technology sector. It's also the third leading income producer in the IBP, where it generates more than $150 a year. These latest buys added about $23 to the IBP's expected annual income production, and Broadcom and Comcast are projected to bring in about $216 in combined dividends over the next year, about 7% of the IBP's total. If you buy a stock before a company's ex-dividend date, you'll receive the next dividend payment. That's exactly what we did with both of these stocks, as Broadcom's ex-dividend date is June 14th and Comcast is July 6th. So when both companies pay their next dividends this summer, the IBP will get paid for all the shares in the portfolio, including the ones we just added. The income the IBP receives then will be reinvested right back into each company. That dividend reinvestment process often is called dripping, and dripping is a big part of the way we're making such great progress toward the portfolio's income target. Now let's take a look at each company's operations. Broadcom recently released its second quarter earnings report, and it was a beauty. Sales were up 15% year over year. The semiconductor solutions segment was up 20%. The networking products segment up 10%. Wireless revenue up 48%, thanks largely to Apple's rollout of the iPhone 12. That Broadcom is performing well is nothing new, as this data from the last 5 years shows. Due to the semiconductor shortage, President Biden wants to include billions of dollars in his infrastructure package to ramp up production from American chip makers. Naturally, once politicians get involved, it's hard to predict what will happen. But if the sides do eventually agree on this, it will be yet another major boon to Broadcom. It's an important company with a customer list that reads like a who's who of humongous corporations: Apple, Verizon, Boeing, Honeywell, Alphabet, Lockheed Martin, so many more. And hey, one of Broadcom's companies just happens to be Comcast. Our Comcast position has gained about 50% in the last 2+ years it's been in the portfolio, and over the last decade, Comcast has killed the market. Still, 2020 was a challenging year because of the pandemic, as revenue, EBITDA, earnings per share, and free cash flow all took small steps backward. But things did start improving late last year for Comcast, and the first quarter of 2021 showed off the resiliency of the company's business, with year-over-year improvements in revenue, EBITDA, and earnings. Comcast's chief financial officer recently said that the company's Universal theme parks were recovering nicely as pandemic-related restrictions are being lifted. In Florida especially, he said, they're having some days where they're actually doing better business than they did in 2019 pre-COVID. Lastly, let's take a quick look at the valuation for Comcast and Broadcom stock. 16 of 18 analysts surveyed by TipRanks say Broadcom is a buy, and the average target price represents a 14% upside from now. It's a similar story for Comcast, with 15 of 18 analysts calling the stock a buy, and a target price that suggests a 12% upside. I found more of the same when I looked at what several analytical firms had to say about Comcast and Broadcom. Morningstar raised its fair value on both, but its analysts still believe that Broadcom is a little overvalued. They say Comcast is fairly valued. CFRA says both companies are pretty fairly valued. Value Line and Credit Suisse says the prices of both companies have a lot of room to run upward. Broadcom and Comcast aren't what I would call great bargains, but they are great companies. And I don't think they're crazy expensive now either. I had no problem committing another $500 of Greg's money to each of them, that's for sure. And I'm glad they're part of our Income Builder portfolio. I'll be back in a week or two with another video about new buys for either the IBP or my other real money portfolio, the Grand Twins College Fund. Again, please give us a thumbs up, subscribe, and ring that notification bell so you don't miss out on any of our new content. Take it easy, everybody. Back at you soon.